Hi, I'm Jimmy. In this video, I'm going to walk through the 10 best dividend-paying stocks that should do well going into 2020, even if the stock market crashes. So what I did is I took the Dividend Aristocrats ETF, that ticker symbol's NOBL, and I looked at the total return for each of the 57 companies that are in that ETF, and I examined the total return in both the Great Recession and the dot-com bubble. I then selected 10 dividend-paying stocks that had good returns for both time periods while maintaining their dividend. I was also careful to only include companies that had a current dividend coverage ratio of more than 1. And just so we're on the same page, a dividend coverage ratio, basically what we do is we take the amount of profits and we compare it to the amount of the dividend paid. So if you had $1 in profits and you paid out 50 cents in dividends, you'd have a dividend coverage ratio of 2. So the key to this is to have a dividend coverage ratio higher than 1. Now, 1 really represents 100%. So anything over that would be a good sign. So this is what the S&P 500 did during the tech bubble. So what I did is I took the high from this point and then the low right here. And I said, okay, that's the market fall. And then I added 1 year to the market bottom to basically account for at least the beginning part of the recovery. And for the tech bubble, we're left with this time period. So that's from about September of 2000 to August of 2003. Then we switch over to the Great Recession, and there we did the very same thing. So I went from the high, which was in October of 2007, all the way down to the market bottom, which was in March of 2009. Then we added a year, giving us a total time frame of right here. If we're curious, during the tech bubble from bar to bar, well, the S&P 500 was down a total of about 28%. Now, that's assuming that dividends are reinvested back into the index. All the return numbers that I'm talking about in this video are going to assume that we reinvest all of our dividends back into that stock. Then, for the Great Recession, also from bar to bar, well, there, the total return was down about 23%. So I'll leave the numbers up here during this whole video so we can have something to compare it to as we go from stock to stock. Now, all the companies that I touch on in this video, I'm going to touch on very, very quickly to prevent this video from getting too long. So if there's any company that is interesting to you that you think deserves a deeper dive, please let me know in the comments below and I'll do just that. So for now, I'm just going to hit the high points and then we're going to look at how they performed, what their dividend is. We're going to move on, and hopefully we can use that information to help guide our portfolios if the market were going to crash, whenever that is. Okay, so the first two companies come out of the consumer discretionary sector. The first company is Leggett and Platt, ticker symbol LEG. So Leggett and Platt manufactures a ton of different products around home and office furniture. They also do some wire products that they run out of their steel rod mill, and the list goes on and on as far as the products that they make. Their dividend yield is a bit over 4% right now. So this is the LEG stock chart going back to the tech bubble. During the tech bubble, LEG was up about 37%. Compared to the S&P 500, that's pretty good. When we switch over to the Great Recession, well, there we can see that during the Great Recession, LEG was up just short of 23%. Now, we may look at this chart and we may say there's no way that this company was up 23%. And that's true from a price perspective. But as I already mentioned, all of our returns, all the total returns that I'm talking about, I assume dividends are reinvested in them. And that's important because it assumes that we reinvest these dividends down here when they paid a dividend, or back here when they paid a dividend, or even up here when they paid a dividend. So when the stock price is lower, well, we're able to buy the shares of this company at a cheaper price. That is one of the advantages of investing in dividend stocks that consistently raise their dividend. Like every company on this list, that's exactly what they do. Okay, next company on this list, also in the consumer discretionary sector, and that is the VF Corporation, ticker symbol VFC. VFC is an international apparel company. They own jean brands like Wrangler or Lee, and then they own companies like Dickies, the North Face, Timberland, Vans, and a decent amount of other brands. Now, right now, VFC has a dividend yield of about 2.3%. During the tech bubble, VFC put up more than 90% gain. And then when we switch over to the Great Recession, well, here they posted up almost 5%. So once again, compared to the overall market, they did quite well. Okay, now we're switching over to consumer staples, where we have 4 good dividend-paying stocks. The first is a classic blue chip name, Colgate-Palmolive, ticker symbol CL. Colgate makes toothbrushes, toothpaste, shampoos, soaps, deodorants, and the list goes on and on. So they're basically selling all the stuff that we would expect people to continue to buy even if the market crashed. Right now, Colgate has a dividend yield of about 2.3%. When we check out the tech bubble, well, during the tech bubble, Colgate was able to put up a total return of almost 16%. Now, if we switch over to the Great Recession, now we can see that there they put up a total return of about 23%. And this is one of those companies that I would expect to do well in almost any recession, since the products that they sell, as I mentioned, are somewhat recession-proof. Okay, next up we have Hormel Foods, ticker symbol HRL. This is another classic consumer staples company that we would expect to do well, and that we would expect them to sell a lot of product if the market were to pull back or the economy were to pull back. They sell a lot of foods. They have frozen foods, not frozen foods, meats, sliced meats, the list goes on and on. Right now, they have a current dividend yield of a bit over 2%. And when we jump over to the tech bubble, well, there we can see that Hormel Foods put up fantastic returns of more than 60%, way outperforming the S&P 500 during this time period. When we switch over to the Great Recession, well, here they did a solid 20% thanks to their consistent dividend payments and, of course, assuming we're reinvesting our dividends. Okay, on to our next dividend-paying stock. This one is McCormick, ticker symbol MKC. McCormick is the largest seller of spices in the world. They sell spices, seasoning, sauces, things along those lines. Currently, McCormick has a dividend yield of a bit under 1.5%. And when we switch over to the tech bubble, well, there we could see that MKE did fantastic, posting a total return of more than 110%. And when we switch over to the Great Recession, well, once again, they performed well, putting up about a 13% gain after accounting for dividends. Okay, our final consumer staples company is Walmart. Walmart is the largest brick and mortar retailer in the world. They currently have a dividend yield of just shy of 2%. And when we look at the tech bubble, well, we can see that they picked up a decent return of about 23%. Then when we switch over to the Great Recession, here they also did fairly well, posting up a total gain for this time period of about 25%. So once again, compared to the S&P, these companies are doing pretty good. Okay, now we jump over to the industrial sector where we have two companies. The first one is A.O. Smith, ticker symbol AOS. AOS currently pays a dividend of just shy of 2%, and they focus their business on water heating and water treatment equipment. During the tech bubble, they posted a return of more than 100%, and then during the Great Recession, they posted up a gain of about 10%. Once again, not bad, especially compared to these guys. Now, our other industrial company is W.W. Grainger, ticker symbol GWW. Grainger distributes and maintains more than 1.9 million industrial products. They do supplies, equipment, tools, things along those lines. They do a ton around various industrial products and tools and equipment, things like that. They have a dividend yield of a bit over 2%. During the tech bubble, GWW had a total return of more than 75%. And when we switch over to the Great Recession, well, here they put up a respectable 19%, once again, assuming all the dividends got reinvested. Okay, now we're down to our final two companies. Next up, we have Sharon Williams from the materials sector, ticker symbol SHW. Sharon Williams sells paints and coatings to industrial, commercial, and retail customers, mostly in North and South America. They have the smallest dividend yield of all of our companies of a bit short of 1%. Now, during the tech bubble, we can see that they did great, posting up a gain of more than 47%. And then while the Great Recession was going on, well, they did a decent, putting up a gain of about 5% during that time period. But compared to the S&P, quite good. Next up, we have our only utility company on the list, Consolidated Edison, ticker symbol ED. Con Ed distributes electric services in the northeastern part of the United States. They have a dividend yield of a bit more than 3%. Now, during the tech bubble, they did quite good, posting up a total return of a bit more than 54%. While the Great Recession, they did decent, posting up about a 5.3% gain. So once again, the goal of all of this was to try to find companies that have historically done well during a recession and could do well going into 2020. I would expect most of these companies to do fairly well in a broad economic pullback. Now, we may have to dive deeper into some of these companies. If there's any of them that would be more interesting to you, please let me know in the comments below. But overall, I would expect many of these companies to do well for the coming years. Hopefully you found this video interesting. And if you haven't done so yet, please hit the subscribe button, hit the thumbs up, and thank you for sticking with me all the way to the end of the video. I'll see you in the next video. Thanks.